Our final consolidation adjustment that we need to learn for F3 is what's known as a fair value adjustment. Now, when we look at the point of acquisition for a subsidiary, and we look at what's there at the acquisition, do you remember we have a look at the subsidiary's net assets at acquisition? Remember, net assets are assets minus liabilities, and if you remember, we use the equity account as indicative of net assets because net assets equals equity or capital, just like we saw in incomplete records. Now, usually we measure the subsidiary's net assets at acquisition to find what figure? Can you remember? Well, the figure at the bottom for net assets of the at acquisition column in the working called net assets list. Do you remember that we use the total of that column to help us find goodwill? Now, goodwill is the fair value of what we give in terms of cash to the subsidiary in return for the fair value of what we receive, things, assets and liabilities, net assets. Now, fair value is most commonly known as market value. And a lot of the time in the financial statements, we don't use fair value. We only use book value, cost minus accumulated depreciation. Now, that's fine, okay? Book values are absolutely fine. We could choose to revalue if we want to. Remember, we saw that in non-current assets very early on in the course. But a lot of the time, the book value of the subsidiary's assets is used in their financial statements. And remember, we pick off the figures of equity balances, which is your net assets, which would be the book values. Now, sometimes the book values of assets and liabilities may not be the same as their true market or fair value. And as such, we may need to do an adjustment on the date we acquire the subsidiary in order to make sure that all their assets and liabilities are at their true fair value. And that's going to make goodwill more realistic. You're comparing the market value of what you give in cash in return for the market value of what you receive, things, assets and liabilities, net assets. So we're going to be comparing like with like, fair value to fair value of what we give, fair value of what we receive in return. So if there's a big difference between the fair value of the subsidiary's assets and liabilities and their book value, we may need to increase or reduce the book values to reflect their fair value on the date of acquisition and therefore would make goodwill calculation more realistic and more true to today's values. So, let's first think about then what the term fair value is. Now, by definition, fair value is defined as the amount for which an asset could be exchanged or a liability settled between knowledgeable and willing parties in an arm's length transaction. So, in other words, how much could you sell an asset for today to a knowledgeable, willing customer in an arm's length transaction, so under normal commercial terms with no discounts? Market value. It's generally accepted that market value is fair value, and that's what you've seen when I referred to fair value in previous videos. So, we may need to essentially adjust the assets of a subsidiary up or down to their fair value before we can calculate goodwill. So fair value adjustments really affect the subsidiary's net assets, which in turn will affect goodwill. So now let's take a look at an example where we need to think about fair values when we're thinking about calculating subsidiary goodwill. So, S has the following equity balances. At the 1st of January 2011 and at the 31st of December 2011, we can see we have the following equity balances. Equity $1 share capital, we see then that the $1 would be the par value, share premium and retained earnings. These are all the equity balances of S at two dates, at the start of the year and at the end of the year. Now remember, we call equity net assets. Remember, net assets, assets minus liabilities always equals equity capital. So these are the net assets at 2 dates. Let's have a look at the information underneath this then. P acquired 80% of the equity share capital of S on the 1st of January 2011 for an agreed cash amount of 600 million. So can you see then, P acquired control over S on the 1st of January 11. So S must be a subsidiary, P must be the parent, and the acquisition date is the 1st of January 2011. And you see then that we've been given the net assets for the subsidiary at acquisition at the top of this question. At the date of acquisition, 1st of January, the fair value of S's assets were approximately equal to their book values, with the exception of some land that has a fair market value of $50 million, but is currently carried at $40 million in S's financial statements. So in property, plant and equipment, the subsidiary is currently showing this item of land at 40 million, when really the true market value today on the date of acquisition is 50 million. What we need to do is increase the subsidiary's land up and then also increase their net assets. It's like a revaluation, but we call it a fair value adjustment because it only happens on consolidation. The fair value of the non-controlling interest at acquisition is $200 million. So we always use that for goodwill and valuing the non-controlling interest itself. And the requirement: calculate the goodwill arising on acquisition of S and show the required double entry for the fair value adjustment. Hopefully you all remember the calculation for goodwill because it's one of those little workings that could get tested for 2 marks in the exam just by itself. Now, we saw the calculation of goodwill when we had a look at our first example in this chapter, if you remember. So if you like, go back to that example and pull out your working for goodwill. Can you see then it starts off with the fair value of consideration plus the fair value of NCI minus the fair value of net assets at acquisition. Now we've got the fair value of NCI and we have the fair value of the consideration, the cost of the investment. If you remember, we were told about that in this first sentence. We paid $600 million to acquire 80% of the subsidiary. What we don't know is the fair value of net assets at acquisition. So we need to work out the net assets at acquisition in order to get goodwill. We also need to incorporate this fair value adjustment that we need to do to the subsidiary's land. So let's have a go at answering this question then. So fair value adjustments are example. Now, the fair value adjustment will affect the subsidiary's net assets. And as such, the first thing we need to do before calculating goodwill, which is what the question wants of us, is we need to calculate the net assets of the subsidiary first. At acquisition, 1st of January 2011, and at consolidation, the 31st of December 2011. We're working in thousands by the looks of things, so we should do the same in our answer. And remember, we list out all the subsidiaries' equity accounts as indicative of net assets. So, we've actually been given the net assets. You remember we wrote up that they were net assets for the subsidiary at acquisition, at consolidation, the year end. So, we're going to use each of these figures and put them into the net assets list. We're just going to copy them. So, starting off with equity share capital. In the question we were told That was $300 million. We'll copy that in. We also had share premium for the subsidiary, $150,000 and $150,000. We were then told about retained earnings. At acquisition, $100 million, and at consolidation, $160 million. There's been growth post-acquisition in the subsidiary. Now, what we also have to incorporate is the fair value adjustment. The book value of the subsidiary's assets now, at acquisition, are $40 million. We want that value to be $50 million. So how much do you think I need to adjust for? Well, it would be, for the difference, $10 million. Now, do you remember when we revalued, and this is probably the closest you've probably seen to a fair value adjustment. When we revalued a non-current asset, we increased the asset and we increased the revaluation reserve. We increased owner's equity. Well, that's really close to what we're going to do now. We're going to increase the land asset for the sub, and then we're going to increase the equity at the acquisition date. So, fair value adjustment, abbreviated to FVA, for land. It will be the difference between the fair value, which we were told was 50 million, we're going to work in thousands, and the book value, or the carrying value, which we were told was 40,000. The fair value adjustment then, we would need to increase the assets at the acquisition date by $10 million. That's all a fair value adjustment is. Okay, so that's all a fair value adjustment is. All you are doing is increasing land and increasing the subsidiary's equity. Now, that equity doesn't just disappear 1 year later. It will still be there at CSFP, at consolidation. Okay? So a fair value adjustment will affect both at acquisition and at consolidation. So, what we've essentially done here is credited and increased the subsidiary's equity. The debit would go and increase group property, plant and equipment, PP&E. So land forms part of property, plant and equipment. So we debit and increase group PP&E on the face of the statement of financial position. And then what we would also do is increase the subsidiary's equity at acquisition and at consolidation. That would be the credit entry. And that's all we do with a fair value adjustment. It will affect the net assets, but also increase group PP&E. So do you remember when we did non-current assets, we had property, plant and equipment, open up a bracket, parent plus sub. Well, then you're going to plus 10 million to increase the value of the sub's PP&E. And if it increased the sub's assets, it increases the group's assets overall. So, totaling this up then, that's going to give us 560 million fair value of net assets at acquisition. And then at consolidation, 620,000 is the fair value of the subsidiary's net assets at the year end. So remember, this is the fair value or true today value of the subsidiary's things, assets and liabilities. We need to find the value of the people, the thing, the people, the excellence or reputation of the business. So, we need to use the 560. Remember, we use that for goodwill. The growth post-acquisition of 60,000 560 million, will go to two places, if you remember. Group reserves and also the non-controlling interest will want their share. Now, we've not been asked to do any of these calculations, but if you were in the exam, you need to do the net assets list and incorporate the fair value adjustment before you can do those two workings if you were asked for them. We were only asked for goodwill. So, let's recap then on how we calculate goodwill. We always do goodwill straight after we've worked out the net assets for the subsidiary at acquisition and at the year end. So, goodwill then will always look the same. Fair value of consideration plus the fair value of the NCI. That's going to give you the fair value of the business. You are then going to less the fair value of net assets at acquisition that we've just worked out. The difference between the value of the business and the value of the things in the business will give you the value of the people, the goodwill, the excellence, the reputation, your customers, your staff. So, let's find the fair value of the consideration. Do you remember that is simply just the cost of investment? So the cost of investment was $600 million. So we'll tick that off. And we also know the fair value of the NCI acquisition, the fair value of the 20% I don't own in the sub was $200 million. So we've got $600 million fair value of consideration, the cost of the investment, plus $200 million, the fair value of the NCI, the value of the other 20% of the sub that I don't own, which is going to give us the fair value of the entire subsidiary on the date we acquired 80% of them as 800,000, or 800 million, should I say. We're going to deduct the fair value of net assets at acquisition, and we had just worked that out, that incorporating the adjustment to increase the value of the land, that's going to be 560 million. So we're going to take off 560 million from the 800,000, and that's going to give us goodwill on acquisition of 240 million. And that would be the true value of goodwill at the date we acquired the subsidiary. And that's what would go into the group statement of financial position. So with a fair value adjustment, just remember to increase the subsidiary's net assets list and then add the adjustment to group PP&E on the face of the consolidated statement of financial position. The adjustment is just the difference between the fair value or market value and the book value or carrying value of the asset on the date of acquisition. And that's all our consolidation adjustments done. So you could get asked about these in isolation, or you could get asked about them as part of a calculation. And something like we've just seen with this example could be what you see for 2 marks in the exam.